Hello, everyone. Thank you for joining today's web conference, the CNR 2024 August Market Update. My name is Elizabeth Dooley, and I'm a Senior Portfolio Manager at City National Rockdale. I will be moderating today's presentation. I'm joined by key leaders from CNR's investment strategy team, including Chief Investment Officer Charles Luke and Senior Economist, Senior Portfolio Manager Paul Single. The views and estimates you hear today are sourced from our investment committee's weekly meetings. During today's call, our presenters will share their perspectives on what's in store for the economy and markets and implications for client portfolios in the coming months. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar, so please type them into your console's Q&A window anytime during the session. You can also download the presentation materials using the resources window on the right side of our console. I'll now turn the call over to Charles.
Great, thanks, Elizabeth. So we have put a lot of thought into the format of these webinars, so I do encourage everyone to leave some feedback if you have some time at the end of the presentation. Also, please do drop your questions in the chat. We have allocated more time today to Q&A to address what's on your mind. But most importantly, thank you so much for tuning in and spending some time with us. So for the run of show today, we're going to start with our market perspectives, covering some of the recent changes to our speedometers and forecasts. And we'll also put some of the recent market volatility into context and discuss our geopolitical thoughts and how we view some of the current election dynamics. Paul is then going to provide an economic update. He'll focus on the consumer, the labor market, and inflation. And I'm just going to wrap up with some thoughts on our market positioning in both equity and in fixed income. So if we turn to our speedometers, what we're seeing is a little bit of movement that we've had both in July and August. So thinking about the changes that we did make in July to monetary policy, housing, sentiment, and inflation, we have continued to adjust in August the policy dial further to the right. That's now going to enter the green zone. And then we also have changes to the yield curve, interest rates, and the business outlook. And on the business outlook side, that's mostly based on the potential for project spending after the election. And so when we think through those changes, two main themes emerge. The first is that the Fed is set for its first rate cut in September, and that will bring some relief to businesses. So if we think about solid growth and lower short-term rates, the yield curve should improve, and longer-term rates like the 10-year Treasury may drift a little bit lower. The second theme is that the election is causing business owners to hesitate on new projects. So we do expect some pent-up growth to be released after the November election, regardless of who the candidate is the day after. We also spent a lot of time debating the labor market, but we did choose to stay in the green zone here. We do not see a broad deterioration in employment, and Paul's going to dive in and provide some more details on that. So shifting over to our forecast, we have made some modest shifts. So for 2024, we still see full year GDP around a 2% level. And that's with the economy, after we just found out yesterday, still growing at about a 2.8% level in Q2. So that's well above the pre-pandemic trend. We also expect the economy to continue to slow towards its long-run potential range of about 1.5% to 2% in 2025, but we will avoid a recession. We also adjusted some of our inflation estimates. We equalized nominal and core CPI, so that's oil and food that's included in the core, that's excluded from the core CPI numbers, but we do expect those measures to converge by the end of the year. And then last, we did adjust our Fed funds target to allow for 75 basis points of cuts. And we think that's likely to come in 2 cuts before the end of the year. And those cuts may come in 25 basis points, or we could see one with a 50 basis point move, but we do think that's unlikely right now. And then we did lower our 10-year Treasury range just by 10 basis points, and we adjusted the 2025 range for slightly lower long-term rates. So the main takeaway here from our forecasts is that we do expect continued growth with lower inflation and interest rates providing a tailwind for the economy. So let's get into some of the current market dynamics. And I want to talk about the recent volatility that we saw back in early August. So ultimately, if I had to characterize it, lower US inflation data and the weak jobs report that we got were accompanied by a Bank of Japan move to raise interest rates. So what happened with this is it squeezed out leveraged investors who were borrowing money in yen in Japan at near zero interest rates, and then investing that in other areas and other currencies around the world. And so very quickly, we saw Japanese stocks drop about 20% in 2 days, but it was relatively concentrated in Asian markets. But this caused a lot of US commentary to predict a market collapse here in the US. But we took a step back from that and reviewed our forecasts, and we did decide to stay the course on our allocation, and that did prove wise. So if we look at the numbers since August 5th, the S&P and the NASDAQ are both up around 8%, nearing all-time highs. And then if we think about value-oriented sectors like financials, utilities, staples, and healthcare, they have performed very well, and we do have some exposure there. And then just to dive a little bit further into that, utilities are up over 10% quarter to date. And then behind tech for this year, utilities and financials are the two best performing sectors. So to tie a bow around the volatility, we do believe the brief down move here was driven by technical selling pressure, not fundamental issues. And we do think that it's likely this episode specifically and the reasons behind it are done for now. So the next item I wanted to turn our attention to was the geopolitical landscape. So certainly a lot is now happening in the Middle East, and we are concerned with US assets moving into the region. And that does raise questions about increasing US involvement, which will worry us. But on the flip side, if we think about some of the positive developments, ceasefire talks have started in Egypt, and there is some positive news coming out of those meetings between Israel and Hamas. But historically, Middle East conflicts haven't caused significant market damage. And we're still watching Russia and Ukraine closely, but we have seen major market movements that really haven't happened based on some of the changing dynamics in the war. And so we would characterize the impact from that conflict right now as relatively neutral. But our biggest concern is what's going on with China. Obviously, it's the world's second largest economy, and it's going to have a potential impact on AI supply chains. And if we think about both election candidates, they're likely to employ additional tariffs. So I think tensions will remain high on trade. And then if we look at China's economy, it continues to slow. That may limit its ability to act on stated policies, but we do worry that that may back China into a corner. So if we go to a high level here, investing with so many constantly shifting scenarios is definitely a challenge. So what we try to do is focus on companies with long-term potential and emphasize diversification. And so one nice element that we haven't had before in today's environment is that the bonds are behaving normally again. And that's providing a nice differentiator relative to equities. So let's get into the election. First and most importantly, I want to underscore, and if you come away with nothing else from the webinar, the stock market is not partisan. So if we take a look at this slide, it shows that regardless of control since 1933, there's virtually no correlation between stock market returns and party control. So the market tends to perform based on broader economic factors rather than which party is in power. And this historical perspective should give us some reassurance that the market can thrive under various political scenarios. But what is going on with the election, and what do things look like right now as far as the head-to-head numbers? So we view the race as being back to a dead heat if you take a look at this slide. And the most likely outcome that we're going to see is a divided government. So the key takeaway is that while the political landscape is highly unpredictable right now, the stock market has shown resilience and adaptability. So investors should be focused on long-term fundamentals rather than a lot of these short-term political events we're likely to see over the next few months. But ultimately, the race will come down to the wire. So positioning based on each candidate, we don't think is wise at this time. But it's still important for us to spend some time thinking about which sectors can perform well based on the details that we have on each candidate's party platform. So if we take a look at Harris first, a lot of the initiatives and prioritization around renewable energy, electric cars, and environmental policies are going to have continuity from Biden to Harris. Further, part of the Inflation Reduction Act really was to expand and enhance access to broadband networks. So we do think that telecom will have some support. And then, of course, the recent announcement that we saw from her on the housing initiative front could benefit home builders and other industrials that provide infrastructure development. And while I hesitate to say that tech would benefit most under a Harris presidency, it's more about continuity and less about policy. So I'm not convinced that Trump would be bad for tech. It's simply that I don't think there's a lot of clarity around the approach he might take. But if we flip to Trump, A rollback of regulation, an increase in defense spending, and policies to increase drilling would certainly benefit banks and financials, the aerospace and defense sector, healthcare, and then more traditional energy companies. But it's incredibly important to note that while certain sectors can benefit from specific policies, the overall market performance is going to depend on a variety of factors. So what I wanted to look at was, does sector outperformance last? And so if we take a look at this slide, it really gives us a word of caution, right? So we have to focus on sector, industry, company fundamentals, market cycles, macroeconomic factors. We've got global dynamics, changing relationships, and those are all going to dictate the path of the market. So what if I told you that from election day of 2016, the renewable energy sector spiked more than 1,000% under Trump, only to fall more than 900% under the Biden administration? So you might say that's unfair. What about COVID? But then I turn around and say, exactly. COVID was a much bigger force and factor on the market than any sector-specific policy could ever be. And the same thing can be shown on the right-hand side. So if we look at under Biden's current term, aerospace and defense jumped about 16% versus just 6.6% under Trump. So we are and we will take advantage of the companies we believe will benefit from any long-term policy implications. But if we think about the high uncertainty over who the candidate will actually be, it's very important for us to focus on the best companies in each sector instead of trying to load up on any one sector in particular. So a few key takeaways from my comments here, and then I'm going to pass it to Paul. But we believe the economy is slowing, but it's not headed for a recession. So we have adjusted our forecast to align with long-run potential GDP growth of about 1.5% to 2%. If we take a look at recent market volatility, we think it was almost entirely driven by technical factors, and the fundamentals that we see do not suggest that the scope and magnitude of the panic that happened in August was warranted. We also know the geopolitical environment remains a challenge. So our two main risks are US-China relations and the US involvement in the Middle East. And then we would strongly advise that you don't hang your hat on sectors that may or may not outperform under either candidate's current platform. And we do think a divided government is the most likely outcome, and sector benefits are typically fleeting after November. So I'll stop there and pass it off to you, Paul, on the economy.
That's great, Charles. Thank you so much. And as Charles was saying, the pace of economic growth is expected to slow, mainly because we're just in a much more mature phase of the business cycle than what we have been in the past. The economy has done extremely well, despite all the news that we seem to read for the last few years about this recession that's supposed to happen. But in fact, as we know, it hasn't happened, nor do we expect one to be happening in the near future. Growth in GDP for the second quarter was revised this morning to 3%. For the past year, it's been at 3.1%. Since 2021, the year following the volatility of the pandemic, growth has been 3%. So the economy has continued to move well. The big driving force of that really has been the consumer, of course. It's been the cornerstone for growth. The chart here on the left-hand side, gray columns represent recessions, but you can see that the pace of personal spending, which is the data that feeds right into the consumption calculation for GDP, which is 2/3 of GDP, you can see for the 10 years before the pandemic, it was quite linear. We took a trend line of that and extended it. And you can see how the growth since the recession in personal spending has been much stronger. And this has been what's been driving the economic growth. The unemployment rate has come down. People have created wealth. They've gotten income that's higher than inflation rate in general. And as a result, that's allowed for the spending. But we see a maturing going on in how people spend their money. And that's an important element to keep track of. The chart on the right is measuring the discretionary spending as a percent of total spending. Now, the discretionary spending is the stuff that you want to spend money on, not what you have to spend money on. But you can see in the top right corner that that's no longer following the trend line that it had been on, and it's starting to slow down. And we can see that. This chart here is on purpose going back to 2005, because you can see the slowdowns between the previous recessions that had the same event. Now, that doesn't mean we're going to be entering a recession, because keep in mind what was happening before those two recessions. Before the pandemic, the economy was slowing down because of the trade war with China. That greatly impacted the manufacturing sector, which put it into a recession for that sector, and also agriculture because of the tariffs that were put in place. So we saw the Fed lowering interest rates because the economy was slowing. The same thing for the global financial crisis. The high housing costs started to drop, and that caused a slowdown in the pace of economic growth. The recession was because of the banking crisis. That was something completely separate. But this is classic that you see going on for spending in a business cycle where the spending changes quite a bit in terms of what people want. This chart here on the left-hand side shows that the stock market is seeing the same sort of thing in terms of the spending. The shaded area that you see here, this is for context. This is the S&P 500, the percent change since the beginning of the year. But the dark blue that you see, the discretionary retailers, you can see the growth in the stocks here is not nearly as strong as what you see in staples, or what economists refer to as non-discretionary, where it has been quite strong. Earnings for both of these has been a surprise and it's been much stronger. And it's really showing that the fear of the consumer, those worries are pretty much overblown. Consumers continue to be spending money. The thing is they're spending it on things that they have to rather than things that they choose to. In terms of the risks of a recession, as you know, we don't see one in the future at all. In terms of the next year or so, we put the probability at extremely low levels. But as, the companies in the S&P 500, in terms of recent meetings, you can see that that number is extremely low. Much different than what we saw just a couple of years ago when there was a great deal of concern, but it's very, very low right now. Again, it's being driven by the fact that consumer income remains strong, the unemployment rate remains quite low, and people will continue to spend to drive economic growth. In terms of the ancillary talk that we hear about how people don't have enough money to spend, that inflation is too high for them, yes, absolute prices are high, and yes, it does impact a certain group of the population, but not the majority of the population, and that's what drives economic growth. On the chart here on the left-hand side, it's just showing that income that we're seeing at households based on their, this is the income into different quintiles. You can see across the board, it's quite positive. And an average of 2.4% is enough to continue driving economic growth. In terms of who spends money and how much money they spend, the data here on the right-hand side shows that. And it's not equally distributed, of course. Over on the very far right-hand side is the top 20th percentile. And you can see that they spend almost 40% of all retail sales that's going on. The bottom quintile, you can see, is about 1/4 of that level. But even if you broaden it out, you can see the differential remains quite wide. So we expect to continue to see spending remain strong until you start seeing an unemployment rate of the higher paying jobs start to increase significantly. And again, we do not see that in the near future. Consumer spending will continue to be positive. And here it is in terms of the employment situation. Yes, the unemployment rate has moved up. It's at 4.3%. It's up from the lows of a year and a half ago. But let's put this into some long-term context. Here on the chart on the left-hand side, you can see how it is quite low, levels that we haven't seen since the early 1950s or the late 1960s. In both cases, it was extremely low then because we were at war, Korea and Vietnam. We had a draft back then. We lost an awful lot of the workforce into the military. That's not the case right now. Here we have very low level of unemployment, mainly because of the strength of this economy. It's well below the long-term average. I mean, this differential between the two is 1.4 percentage points. That, you know, on 160 million people, you're talking about 2.25 million people there. We have a long way to go just to get to average. So that's an important part to keep in mind. In terms of the fact that the unemployment rate has gone up, we break it down into what's causing that to happen. Here you can see that on the right-hand side. The blue, the dark blue, is permanent job losses that have gone on in the last year and a half. The light blue is temporary, meaning you'll be back to work within 6 months. That accounts for 4 of the 9 tenths. The rest of it is people coming back into the workforce or those that are starting to look for a job. That's what's driving the unemployment rate up. It's supply. It's not the fact that people are losing jobs. In fact, the non-farm payroll number that we get each month, we have yet to see a negative number. And the 4.3% unemployment rate that we have, well, that's pretty close to what the Fed wants it to be, because this is the sort of level that they say is consistent with wage growth that is low enough to keep inflation from being a problem. In terms of the hiring that goes on, yes, there are occasional headlines that you see, the big companies laying off people, but it's important to keep in mind that roughly 4 out of 5 jobs are with companies that are under 250,000 workers. And here on the chart on the left-hand side, you can see the number of job openings that are going on for these companies. It remains quite high. Small businesses, which are far more subject to the high interest rates than large businesses, because small businesses tend to get money that they borrow from banks, unlike large businesses that can do it in the capital markets. You can see that they're still eager to hire people. The index for small business owners in terms of hiring stands at 15, above the long-term average of 11. And in terms of inflation, this is the most exciting news for the Fed. It's been a while. On the chart on the left-hand side, you can see both CPI and core PCE, the two most popular inflation measurements. This is a 3-month change that's annualized. Core PCE is down to 2.3%. That's the one that the Fed likes. But most people tend to follow CPI. It's up only 0.4% for the last 3 months. But more importantly to the Fed is the expectations of consumers for inflation, because expectations can lead to long-term changes. And the fact that you can see here that the expectations for the next year and the next 3 years is pretty close to what it was before the pandemic has many people at the Fed quite happy. But what's causing inflation? Well, the chart here on the left-hand side shows the CPI, and we break it down into 2 major categories. The dark blue is shelter costs, or what it costs for housing. The light blue, well, that's everything else. As you can see, the shelter cost is the major source of our inflation. It's 1.8 percentage points of the total 2.9. Everything else is just 1.1. So if it wasn't for shelter costs, inflation would be just 1.1%. Those are trending down, you can see in the blue area, and we show that over on the right-hand side. Now, calculating the cost for shelter or housing is far more complicated than most other products that they look at for CPI. I mean, they're looking at eggs. They just have a survey and check where egg prices are around the country, and they figure out the percent change. That's it. Housing is a little more complicated because a house is an investment along with being a service in terms of providing shelter. Here, they look at rental prices of homes in neighborhoods where people own homes. Because that's the service cost, and they check it every 6 months. And you can see on the right-hand side, the shaded area is the calculation that CPI has for it. The 2 lines that you see is the change in either home ownership or home rental, and you can see that's far more volatile. Those peaked in 2022, and it's moving down. And you can see the CPI shelter prices, those 2 are moving down, and they're expected to continue that downward trend going on. So the key takeaways here is that the economy is doing fine. It's just moving into a much more mature phase in the pace of growth. As Charles mentioned, we expect to be a little slower than what it had been. The payroll growth won't be as strong as what we've seen in the past. In fact, what we see is the job growth is moving to areas that are less cyclical, like teaching, government jobs, healthcare, that sort of thing. Inflation, we expect to moderate quite a bit and be within the Fed's goal of around 2% at a sustainable level. But the most important issue here, as Charles was saying, that we expect a cut by the Fed in September, is the Fed has made it their sole focus in terms of dealing with the labor market to make sure that continues to have positive growth. And they will cut interest rates as needed. And they have a lot of room to go to impact consumer behavior. So our outlook continues that economic growth will be moving forward at a positive pace, just not nearly as strong as what we've seen in the last few years. So with that, let me turn it over to Charles. Charles?
Thanks a lot, Paul. So I wanted to start my equity and fixed income positioning comments with the market pullback and rotation that we've seen and that began in early July. So it's experienced several ups and downs over the past 2 months. And when we examine these graphs from left to right, I'm going to talk you through each one of these. What we're looking at is the relative ratio, the relative performance on the far left-hand side of growth versus value, of large versus small, and of the S&P versus dividend stocks. So when that line's increasing, growth, large caps, and the S&P broadly are doing better than value, small caps, and dividend stocks. So what you can see is that in July, there was a noticeable peak across all three measures, and that's when the more fairly valued counterparts in the market began to surge. But despite a brief near-term comeback that we did see, the peak outperformance from the rotation has diminished for now. And so we do believe that the more attractive valuations may provide continued momentum for this rotation. And ultimately, as we've been underscoring all year, we are looking for balance in the market. And one of the very positive things that we see related to this is that non-tech earnings have started to rise. In fact, it's the first positive level of non-tech earnings for the past 4 quarters in Q2 earnings season. So if we see any earnings follow through in the coming quarters, the rotation may have legs to continue. I also wanted to spend a little bit of time on just price trends. So what's happening technically in the market. And we don't spend a ton of time on this, but I do think it's really important. So price trends are crucial indicators of market sentiment. And again, we haven't discussed this very much, but it is important to highlight where these prices are. So on the left-hand side, what you're seeing here is the green line represents the 200-day moving average of the S&P 500. And what the moving average is a widely followed indicator that helps smooth out price data to identify overall trend direction. And it's often used to gauge the health of the market. And so earlier this month, the 200-day moving average wasn't breached, and that indicated resilience in the market. And this is a really positive sign for us, as it does suggest that the market is maintaining upward momentum, despite some of the potential headwinds that are potentially out there. And then correspondingly, if we look at the right-hand side, the number of advancing stocks versus declining stocks hardly had a blip through the market volatility. So this means that the breadth of the market, which measures the number of stocks participating in the rally, does remain pretty strong. So from a price perspective, there's nothing that contradicts the rally that we've seen over the past few weeks. And now shifting over to earnings, this has been an interesting component of the market in the commentary here lately, but overall, earnings have been very strong. But this negative sentiment has kind of creeped into the market, especially around the Mag 7 stocks. But let's recap what happened for Q2 of 2024. So in terms of earnings performance, about 93% so far of S&P 500 companies have reported those Q2 2024 results. 79% of those companies have reported EPS above estimates, and that is higher than the 5-year average. And then the blended earnings growth rate for Q2 was about 10.9% relative to around 8% expectations, so about a 3% beat there. And that's the highest since we've seen in Q4 of 2021. And so despite the positive aspects, there are some negatives that we do need to consider. And this is what the narrative was out there in the market. So companies are reporting earnings that are 3.5% above estimates. So these surprises haven't been quite as big. That is below the 5-year average. And then if we look at the revenue side of the equation, it's also a little bit below average, but it's the first quarter since Q4 of 2022 that stocks outside the Magnificent Seven as a group had positive year-over-year earnings, which I mentioned before. So we view that as very positive. So despite some of these negative headlines, we do think there's plenty to like on the earnings front, and there is clear evidence in these numbers that the market can be supported going forward. So the other important element of the market right now, and it's always an important element, is what's happening with valuation. And if we just look at the market cap weighted valuation all the way on the left-hand side here for the S&P 500, it really doesn't tell the whole story in our view. So it's important to dive deeper and really understand the nuances of what's happening. So while it is true that most sectors are elevated above the 10-year average, as you can see here, let's consider several key points. So if we look at these sector valuations and look all the way on the right-hand side, utilities, financials, energy, and consumer discretionary have valuations that are much more in line with their historical norms. So when we saw this rotation, those are some of the sectors that performed very well because of those favorable valuations. And then also in terms of size, if we look at the equal weight, the valuations of large cap stocks versus small cap stocks are also more normal. So this means that while large cap stocks are trading at the higher multiples, small cap stocks really are not as stretched in terms of valuation. So this dynamic is very important because it does suggest that there is some balance in the market with opportunities across different market capitalizations. And one of the features that we really like about this dynamic in the market with these split valuations is that when the broad market has stumbled, the sectors that are better valued have actually cushioned the blow. So for example, if we look back to early August, there was a 22% peak to trough drawdown in tech, but the S&P 500 as a whole only experienced a peak to trough drawdown of about 9%. So this indicates that the broader market does have almost what we could call a built-in mechanism, a cushion when volatility rises, as a lot of these less overvalued sectors do help to mitigate the impact of declines in the more overvalued areas. So while the overall market may appear more expensive, we do think there are sectors that are trading at reasonable valuations, and that's why it's very important to look beyond the headline numbers and consider the underlying components of valuation within the market. So next, let's talk a little bit about our positioning on the equity front. So a few things to discuss here. And so first, I do want to address our tech positioning and then break down specifically our semiconductor exposure, because this is pretty nuanced. But when we think about tech, it's important to separate the AI-themed stocks from just about everything else inside of the tech sector. So primarily, we see the impact in the semiconductors and semiconductor equipment category. Now that category, the one we have highlighted here, is up about 66% year to date. And this subsector for us is our most significant overweight. In contrast, if you look at the other two tech categories, this would be technology, hardware, and equipment, and then software and services. Those have lagged behind the broader S&P 500, rising about 16% and 8% respectively. So when we think about our underweight in information technology, it's not an underweight to the semiconductor and AI industry, it's an underweight to that hardware and technology and services and software. And then if we move on to the communication services sector, we find major hyperscalers like Meta and Google. And this year, Meta and Google have accounted for about 90% of the return contribution for this sector overall. And so we do remain overweight on Google, and we did open a position earlier in the year in Meta. And so overall, when we isolate our Mag 7 exposure, we are essentially market weight to the group with overweights in Microsoft and Google. And then regarding NVIDIA earnings and AI stocks, I do think there are two essential issues that are causing concern, and we'll probably get deeper into this in the Q&A section. But the first thing is that AI companies have really had trouble quantifying the impact of AI in terms of the adoption and use cases in the broader economy. And second, there have been specific issues such as potential chip delays and a little bit of anxiety over the manufacturing process and supply chains. And we do think these concerns are valid, but we also believe we're still very early in the stages of AI implementation. And so if you think about a chip design company like NVIDIA, the key to AI is processing power. So if we think about enterprise implementation at the corporate level, and then as public use ramps up, so too does the need for enhanced and increased processing power. So there's going to be an insatiable appetite for upgrades, and we do think the strains on processing power, the demands there, are going to become heavier and heavier. So therefore, it really is too early for us to call the end of the AI run, and simply put, we feel that you do need exposure to these stocks. And other notable positions on this page do include our overweights in financials, and those are going to benefit from falling interest rates. So again, it's on that Fed theme that Paul talked about and I touched on. With lower interest rates, financials are likely to do really well. And then while REITs and other real estate sectors have performed well over the past couple of weeks with the recent rotation, we still do think the drag from commercial real estate and some of the slowing activity we're seeing in residential areas is still a reason to underweight the sector. And that's outside of data center development. And then additionally, I mentioned this on information technology, but our underweight there, the way it appears, is primarily due to hardware and equipment. And that has underperformed the S&P 500 this year. And it isn't related to the Mag 7 or semiconductor industry. So moving along to bonds, we really like bonds in this environment. And the way that I've characterized it is, bonds are finally starting to act like bonds again. So if we think back during the stock market sell-off in early August, a 60-40 portfolio, and you can see this on the left-hand side, performed very well. And the rise in bond prices when that volatility happened helped cushion the overall portfolio. So this traditional inverse relationship that we've seen between stocks and bonds over history is back. And so with inflation cooling and potential interest rate cuts on the horizon, we do expect bonds to continue playing a significant role in stabilizing a balanced portfolio. And so this means that even when stocks are volatile, we do think that the high quality sectors of the bond market can provide a buffer, and that really is going to help protect and balance out the portfolio going forward. So reasons to be excited there. And then last, I wanted to talk a little bit about our maturity recommendations before we get into the Q&A section. So while we don't see longer term rates dropping substantially, so you saw us in 2024 being somewhere between 4 and 4.5%, given the performance of bonds at these rate levels and the likely path of Fed policy, we do recommend that our investors think about buying longer term bonds. And so if you take a look at this chart, what we've done here is we've summarized fixed income performance over 3, 6, 1 year, and 3 years after the first Fed cut. And so what jumps out to me on this page is that all of the periods are positive for bonds. And over 3 months to 1 year, the biggest influence on positive performance is the amount of sensitivity to interest rates you have in the portfolio. So is how long your bond positions are. So overall, we do think it makes a lot of sense to start shifting the portfolio in anticipation of lower rates. And so to sum up my key takeaways here, inflation surprises and a softening job market, along with the election volatility, has prompted a shift to a lot of this growth to value stocks. But we do think this is largely reversed, but it could have legs based upon where valuations are. And then despite a drop in equities, we do think crucial price levels have not been breached. And that highlights the significance of market prices and I think the positive track that we're on. And then the earnings season has been very good. We surpassed expectations by about 2.3%, right around 11% growth. And so even though the size of those earning beats weren't what the long-term averages have been, they were still pretty tremendous in terms of what we saw for company profitability and performance. And then on the valuation front, it certainly is complex right now. But while some sectors have high valuations, we see a lot of sectors that we do think are more fairly valued. And as I mentioned on buffering downside, those sectors have done very well when other areas and the high flyers have pulled back a little bit. And then on our equity positioning, we do emphasize quality, market competitiveness, and financial robustness. But we are overweight in that semiconductor sector and financials and healthcare, and we remain underweight in real estate and materials. And then if we think about what bonds do in a portfolio, we believe they have resumed their defensive role and they matter in a portfolio now. And they do provide a hedge against equity volatility. So we do like the bond market here. And then we are making a recommendation to our clients to take advantage of the potential Fed path here and to extend maturities on the bond side in their portfolios. So I'm going to stop there on our prepared remarks and pass it off to Elizabeth on the Q&A.
Thank you, Charles. A quick reminder that if you have a question, you can submit it in the Q&A console. It looks like we have quite a few already, so we'll get started. Charles, we've got a couple of questions on the election, so we're going to start there. We're getting more information from each of the parties about their platforms, and one of the first questions that they will face is the tax issue. What is our outlook for tax policy under each candidate?
Great, thanks, Elizabeth. So this is one of the key tenets of our view and things to watch longer term. So really taxes, tariffs, and treasuries, or the amount of bonds the government's going to have to issue. But the first thing that Congress and the president after November are going to have to face is tax policy with the TCJA potential expiration. So we don't have a ton of details from either candidate. We really just have one-liners. But I'll go through each candidate really quickly just to give you an idea of what we may be able to expect. So if we look at Harris, in their plan, no American earning less than $400,000 is going to pay more in income taxes. They're also going to go back to the child and dependent care tax credit and put that back into effect, that the TCJA rolled back a little bit. And then they talk a lot about offshore companies and the potential to close corporate tax loopholes. And so we think they're probably going to take aim at corporations with complex tax structures. Given the divided nature of the government that we're likely to see, I think increasing that corporate tax rate is going to be a little bit of a headwind, but they're definitely going to try as well. They've also discussed some housing tax credits that could potentially be implemented. And then on the corporate tax rate side, they're thinking that those do need to go back up, as I mentioned, and then they will be targeting estate taxes, potentially raising those back to the historical norm. And they do say that their plan is going to cut the deficit by about $3 trillion, but there really are not a lot of details offered on how that's going to happen. Now, if we turn to Trump, we have even fewer details, but I think it's a little bit clearer in terms of what they're going to go after. So they're going for large tax cuts for workers is the way that it's defined, and they do not want to tax tips. They will make permanent the TCJA, so there would be less volatility around that. And they go to eliminate, again, taxes on tips. And then there is an indication that the Trump administration will provide housing tax credits as well. But that's about all we have on the potential Trump policy for taxes going forward. So I think we're setting up here for some fireworks in Congress. And I think certain portions of the TCJ are likely to go forward. But certainly under a Harris presidency, we're not going to get every attribute of that approved. And under a Trump presidency, if the House is Democratic, which we think it will be, we'll be in a situation where it's going to be difficult for him to not compromise a little bit. So lots to watch on the tax front. But overall, it is going to be the main agenda item once we get through November.
Thank you. Paul, we've had a couple of questions on the labor market and sort of the quality of the data. The annual revision of the labor market data last week that created some concern. Are the revisions really that significant, and does it impact our view on the labor market?
Yeah, that's a good question. Last week it was announced that the Bureau of Labor Statistics is going to revise down the number of workers for the year that ended this past March by a little over 800,000. That's a big revision for them. But keep in mind, the impact on the economy really isn't there at all. These are all estimates that are done each month. The data that we get at the beginning of each month regarding the unemployment rate and the amount of people that are hired is an estimate. They have a very complex and detailed survey that's done each month. They go to more than 500 businesses that account for about a third of all the workers that are there. But from that, they figure out what the numbers are going to be. So each year, they calibrate that against actual tax filings, which accounts for about 95% of all the workers that are there. So this is an annual thing that goes on. And really what it's telling us is that the economy, instead of performing as it did with 160 million or so workers, did so with 159.2 million workers. So that's all it means. This is, like I said, this is a regular adjustment that they make. It's just a little bit bigger than normal this year.
Okay, thank you, Paul. Charles, we had a couple of questions related to both equity and fixed income positioning. So when it comes to the equity positioning, you talked a little bit about returns, growth versus value over the last couple of months and some of the rotation in the market. How are we positioned to take advantage of that, both short term and long term?
Sure, perfect. So for us, we've long talked about the importance of dividend stocks, especially in portfolios that are looking for income. So with this recent rotation, we do have some exposure in many of our portfolios that's been able to take advantage of that. And certainly in terms of making adjustments to the portfolio, we talked a lot about sector direction and the short-term impact from which candidate can be. So right now, we really like how we're positioned in the market, and we don't think we need to make a ton of changes. Although we are really considering, and we talked about this on a lot of webinars earlier in the year, about when an international exposure might make sense to lighten some of the focus that we could have on the government in the US over the next year. We've been looking at emerging markets to see if there's any potential benefit there that we can see going forward. So we like where we are, especially in the equity mix that we have, but we are trying to position ourselves to make a move if the market volatility gives us the opportunity to do so. And then on the fixed income side, when we think about positioning and our outlook for interest rates, there are a couple of things that we think are really important. First, you can get a good yield in this environment without taking a ton of risk. So if you think about retirees, and again, those clients that are looking for income, there are a tremendous amount of opportunities now that we just didn't have for the past 15 years. So when I talk about the extension of maturities and trying to push that bond portfolio out, buy some longer bonds, we do think that really is important in this market for a bond portfolio. And then I did see a question come in the chat just on spreads and how we view sort of opportunistic and high yield credit. And so one of the keys, I think, to the economy in here and why we think we have a lot of health is because profitability has remained so high in corporate America, default levels remain low, and companies are performing really well. And so I think that's what's compressing the spread level. And then we're still getting absolute yields in the opportunistic income, the high yield space, north of 7%. So there's a lot to like about that, but we are a little bit cautious about opening up new positions now, just given that that spread could adjust around a little bit. So, overall, we like our positioning in the equity market. We're trying to figure out what's going to continue this rotation, if it will continue, in other areas that might benefit, and then looking at market volatility to take advantage of it. And then we do like the idea of extending bond duration and then looking at different spots in high yield that we think could be beneficial.
Thank you, Charles. We have a number of questions that are related to the election and policy. And I think it's fair to say over the coming weeks, as we get some more information on the various policies that are being laid out, we'll probably cover most of those questions in the next webinar. So we're going to leave it there for today. Thank you all for joining us. A brief survey will pop up shortly in your console, so please share your feedback and suggestions for future topics. A replay of this session will be available within 24 hours, and you will receive an email letting you know how to access it. Have a great day, everyone.
Thanks, everyone.
Thanks, everyone.